If you've followed financial history, you already know that bubbles, manias, and collapses are nothing new. But what happened with FTX wasn't just another market crash. This was a modern financial implosion that unfolded in real time, on social media, in public, and at a speed that stunned even seasoned analysts. At its peak, FTX was valued at $32 billion. It had celebrity endorsements, political connections, and the reputation of being one of the safe crypto exchanges. Then, almost overnight, it was gone. What makes this story essential for serious observers isn't just the scale of the collapse. It's how predictable many of the warning signs were. This wasn't a mystery. It was a case study in risk, trust, and the dangers of unchecked power in emerging systems. Understanding how it happened gives you tools to spot the next collapse before it happens again. How Sam Bankman-Fried built trust faster than the system could verify it. At the center of it all was Sam Bankman-Fried, often referred to as SBF. He wasn't just another tech founder. He crafted an image of a disciplined, mathematically driven operator who cared more about efficiency than luxury. He spoke the language of effective altruism, earning as much as possible to give it away. And that narrative resonated with investors, regulators, and the public. FTX grew rapidly by offering advanced trading features, low fees, and a polished user experience. At the same time, SBF's trading firm, Alameda Research, was deeply intertwined with FTX. This relationship would later prove catastrophic, but at the time, it was largely overlooked. Here's the key takeaway. Rapid trust without transparency is always a red flag. In your own financial decisions, if a platform grows too quickly without clear, independently verified audits, that's your cue to slow down, not speed up. Why the relationship between FTX and Alameda Research was the ticking time bomb. The core issue wasn't just mismanagement, it was structural conflict. Alameda Research was supposed to be just another trading firm. Instead, it had privileged access to FTX's systems, and more dangerously, access to customer funds. FTX allegedly allowed Alameda to borrow billions of dollars using customer deposits as collateral. That's not just risky, it's fundamentally against the expectation users have when they deposit funds on an exchange. Think about it in practical terms. If you deposit money into a platform, you assume it's held securely, not being used for high-risk bets behind the scenes. A simple rule you can apply today. Always ask where your funds are stored and whether they are segregated. If the answer is unclear, that's a signal to reconsider your exposure. How a single report triggered a collapse no one could stop. The downfall began when a report revealed that Alameda's balance sheet was heavily reliant on FTX's own token, FTT. This created a circular dependency. FTX's value supported Alameda, and Alameda's stability supported FTX. Once that became public, confidence started to crack. Then came a decisive move from Changpeng Zhao, the head of Binance, who announced plans to sell Binance's holdings of FTT. That single announcement triggered panic. Customers rushed to withdraw funds. Within days, FTX faced a liquidity crisis it couldn't survive. It didn't have the assets it claimed to hold. Withdrawals were halted. Bankruptcy followed. This is a classic bank run scenario, updated for the digital age. The lesson is straightforward. Liquidity matters more than valuation. A company can be worth billions on paper and still collapse if it can't meet withdrawals. So, where did the $32 billion actually go? And, why does it matter? Well, the short answer is that the money didn't just vanish, it was misused. Funds were funneled into risky trades, speculative venture investments, and of course, loans to Alameda. When those bets inevitably failed, the losses ended up being absorbed by what, frankly, should have been protected customer assets. This wasn't simply a case of poor judgment. It really exposed a lack of basic controls. No proper accounting systems, no independent oversight, and decision-making concentrated in a small, rather insular inner circle. For anyone managing money, even on a modest scale, the big takeaway here is, discipline. Keep separate accounts. Track everything, no matter how small. And above all, avoid commingling funds. These aren't just, corporate best practices. They're true survival principles. Why did regulators, investors and users all miss the warning signs? One of the most troubling aspects of the FTX collapse is just how many experienced players were involved. Major venture capital firms invested heavily, believing in the promise. Regulators engaged with SBF as if he were a credible figure. And users trusted the platform, largely because everyone else seemed to. This is herd behavior at scale, really. When everyone assumes someone else has done the due diligence, no one actually does it thoroughly. In practical terms, you can counter this by developing your own checklist. Before trusting any financial platform, verify whether it provides audited financials, whether it separates customer funds, and whether its leadership has a track record of transparency. If any of those are missing, treat it as high risk, regardless of popularity. What this collapse teaches about modern financial systems and, personal resilience is rather sobering. FTX wasn't just a crypto failure. It was a reminder that new technology doesn't eliminate old risks. It often amplifies them. Speed, complexity, and lack of oversight can, turn small issues into systemic failures almost instantly. For survival-minded individuals and serious observers, the lesson goes deeper. Diversification isn't optional. Self-custody of assets, where possible, reduces reliance on third parties. Understanding how systems work, rather than blindly trusting them, is your strongest defense. Even outside crypto, these principles apply. Whether it's banking, investing, or business, the fundamentals remain the same. Transparency, accountability, and risk management. Why this story will be studied for decades and what you should take from it today is fairly clear. The fall of FTX will sit alongside historical financial collapses as a defining case of how not to run a financial institution. It combined innovation with negligence, ambition with overreach, and trust with deception. But more importantly, it offers a blueprint for what to watch for next time. Because there will be a next time. If you take anything from this, let it be this: don't outsource your understanding. Learn how systems work. Question rapid success. And always follow the flow of money. If you found this breakdown valuable and want more deep dives into financial history and modern collapses that shape our world, Subscribe to the channel and share this with someone who takes their knowledge seriously.